If you have a 401k, you probably think it's your money. You earned it, you saved it, you invested it. But what if I told you the government already owns a large piece of your retirement and they don't take it until the moment you need it most? Today, I'm going to show you the hidden tax trap inside your 401k and why it could quietly steal hundreds of thousands of dollars from your future. Let's imagine something. You spend 40 years building a house. Every paycheck you buy a brick. Every month you add another wall. By the time you retire, it's a beautiful mansion. But then you open the deed and you realize you don't actually own the whole house. The government does. That's what a 401k really is. Most people think a 401k is a retirement account with tax benefits. But that's not what it is. A 401k is a deal. You tell the government, I won't pay taxes on this money today. And the government says, fine, but we get to tax it later. That means every dollar inside your 401k is pre-tax money. Not tax-free, not tax-paid, just postponed. So if you have $500,000 in your 401k, you do not have $500,000. You have $500,000 minus whatever tax rate they decide later. Here's the trap. When you retire, you don't control how much the government spends, how much debt exists, or what tax rates will be. You only control when you withdraw, and when you do, every dollar you take out is treated as income. Not investment income, not capital gains, income. That means it can push you into higher tax brackets, it can increase Medicare costs, it can reduce Social Security benefits. Your 401k can actually make your taxes worse in retirement. And here's the part nobody tells you. Once you reach a certain age, the government forces you to start withdrawing. These are called required minimum distributions. Even if you don't need the money, you don't want to sell, you'd rather let it grow. The IRS says, take it out, now pay us. So your retirement account becomes a tax delivery system. You don't choose when to pay, they do. Now here's where it gets uncomfortable. Wealthy people still use 401s, but they don't rely on them. They use Roth accounts, taxable investment accounts, real estate businesses, because they understand something most workers don't. A 401k delays taxes. It does not eliminate them. And delayed taxes on a large account can be devastating. Let's say you retire with $1 million in your 401k. Sounds amazing, but if tax rates are 25%, you don't have $1 million. You have $750,000. If rates go to 35%, you have $650,000. That's not market risk. That's government risk. Why do you think the government loves 401s so much? Because they get paid later. And later you're older. You're dependent. You have no income. You have no leverage. They can raise rates and you have no choice. You built the house. They own the deed. This doesn't mean don't use a 401k. It means don't believe it's all yours. It's a shared account. You and the IRS are partners, and your partner decides the tax rules. In the next video, I'm going to show you how rich people legally reduce 401k taxes and why Roth accounts work completely differently. Because once you understand how the system works, you stop playing it blindly and start playing it smart.